Hey folks, welcome to Heritage Wealth Planning YouTube channel. I want to take a few seconds today, a short one today, just to talk about a story I had with a client yesterday and how we're going to a successful retirement plan. And it's the simplest, most easy way to build a successful retirement plan. And you don't have to be Warren Buffett. You don't have to be Bill Gates. You just got to have some common sense. And I want to share with you what we did here. So if you like what we talk about here at Heritage Wealth Planning, go ahead. And I think it's on that side, actually, when I'm live. I click on that button right there. It's a tiny little button that says subscribe now. And of course, hit the notification bell. I don't know if you can see that. Be notified of future content. All right, so I'm working with a widow, a recent widow, unexpectedly. She's 61 years old, and like most widows, she's flabbergasted. She's, again, unsuspecting, became a widow, and all the plans that they had for her and her husband have been blown up because of his unfortunate death. I mean, it was cancer related, but it was unexpected. And so because of that, she doesn't know which way to turn. Now, thankfully, I've been friends with her for going on for 20 years or so. And so it's not like she's just going to the great unknown, talking to financial advisors who she should talk to and whatnot. We have a very good relationship, friends of the family for sure. But man, it's a challenge because she's thinking, man, am I gonna have to sell the house? Am I gonna have to go back to work? You know, all the things that she just last year anticipated being able to do with her and her husband, travel, live nicely and whatnot. They're just all up in the air. And now it's the exact opposite, 180-degree turn. Maybe she's gonna have to sell the house. Maybe she's gonna have to move in. I don't know. Maybe even with the kids. I mean, who knows? She have to cut the cable bill. Just all this stuff, and it's just sad because it just catches up on you, especially with widows. There are some widowers like that for sure, but by and large, they're widows. And by and large, there's the man who takes care of the finances, at least the big picture finances. Not all the time, I get that, but by and large, my experience has been that it is. And so the widow who takes care of the day-to-day operations of the home is left, what am I supposed to do with the big picture now? And that's always unfortunate because a lot of times, unfortunately, there are people who can take advantage of that. It's just bad. So in this case, what happened was we got to get these two things resolved, because the two things I'm going to share with you, if you can do it, or at least plan on doing it, you're going to be fine. There's just no getting around that. And so what happened is we're running through the numbers for her, and we're planning on Social Security, like when's the best time to take Social Security. We're planning on when's the best time to take her relatively small pension from the hospital. We're planning on how she should take distributions from her accounts and whatnot. And again, she isn't wealthy. She doesn't have $1 million, but the number one thing is that she's hoping for about $3,000 a month in income. $3,000 a month. Now she's 61 in 8 months. So in 4 months, she'll be 62. Now remember, you can take Social Security as a widow at the earliest as 60 years old. You just got to remember that. Now you're going to take a pretty significant reduced benefit if you do that, but you can. It's available to you at 60. In fact, she had already filed and was taking some Social Security benefits. And so because I hadn't talked to her up to that point. So we got talking about that. So remember, as a widow, you can take Social Security benefits as early as 60. On your own record, you can't. You got to wait till you're 62. But as a widow, you can. So she's already got some Social Security benefits kicking in. And she's like, man, if I can just get $2,500 a month, I'll be fine. I mean, we're actually sitting there thinking, well, let's shoot for $3,500 because I don't want you to have to cut your cable bill. I don't want you to have to think about selling your home and all these things. And so what we did here today is that the number one thing we did is we're going to refile her Social Security. She's going to withdraw her application, pay back the $8,000 to $9,000 she's received so far, so that way she can earn those delayed earnings credits of roughly 8%, maybe 7% a year until she hits about 65. All right, now I'll tell you there's more to this story, but once she hits 65, we're going to reapply. Now, will be reduced based on, because she's not at full retirement age, and for her it's actually 66 in like 4 months. But still, at the end of the day, at 65 is our D-Day. Now, what happens is because of that, her Social Security benefit will be right about $2,300 a month, maybe a little bit less, about $2,200, because it is a little bit underneath what it would be at her full retirement age, because it will be reduced by a little bit. But let's just say $2,200 a month. Now, remember, we're shooting for $3,000 a month. All right, if we can get $3,000 a month, she's going to be in good shape. So if we can wait 3-4 years to take her Social Security, we're going to be 80% of the way there. She also has a pension that she can take. It's not huge, but if she waits until she's 65, it'll be $500 a month. Or if she takes it today, it'd be about $400 a month. And so we figured out, let's just take that today at $400 a month of pension. and so that will at least give us some guaranteed income coming in. Now, the interesting thing is she has an annuity at a firm that's paying about 2% right now. All right. So this annuity is paying roughly 2%, roughly $100,000 in there. The interest rates aren't going up anytime soon. And it's in an IRA as well. All right. The annuities in an IRA is going to come back to her taxable as 100% ordinary income. And so what we're going to do is we're going to annuitize that annuity. It's paying probably about 5% as a distribution rate. So that's $5,000 a year. It's $416 a month right there. And we're going to start that now. And the reason is because with that annuity and with her pension, she's getting basically $900 a month from those two things alone. 900 times 12, what's that? 9 times 12, off the top of my head, I can't remember what's 10 times 12. It's $9,800 a year, right? 9 times 12. So that's less than $10,000 a year. What's her standard deduction? It's $12,000. So if she takes her annuity and she takes her pension from her annuity and from her hospital pension, that's not taxable because it falls under the standard deductions. Now, she also has ordinary qualified dividends and long-term capital gains she can sell on a non-qualified account, a non-IRA account. So we're going to start selling some of this stuff. And as long as that keeps her under the 22% threshold, that comes back to her tax-free as well. So we have tax-free annuity distribution, tax-free pension distribution. And as long as we stay under that 22% threshold, and for a single taxpayer, it's right about $38,500, so right about $38,000. So we have $10,000 a year coming from annuities and pension. That will give us about $20,000, $25,000 a year of selling capital gain, long-term capital gain, qualified dividends as distributions, and she has no taxes because as long as you stay under the 22% tax bracket, you're not going to pay taxes on qualified dividends or long-term capital gains. It's 0%. So she'll have her $36,000 a year without really doing much other than annuitizing the annuity. And that will come back to her tax-free because she has a $12,000 standard deduction. And because of all this, or at least it might be, let's see, if you have the qualified dividends to capital gains, either way, it's going to be taxed as low as it'll ever be for sure. So she'll be in one of the lowest tax brackets she'll ever be. Off the top of my head, I can't remember exactly what it is, but the tax brackets will be minimal while we're deferring her taking her Social Security. Now, when she hits 65, her Social Security benefit will be $2,200 a month. You take the annuity, you take the pension, that's $800 a month, $2,200 a month. That's what's that? That's $33,000 a month, which is $36,000 a year. Now, because of Social Security, you take half of that Social Security. Right, so if it's $2,200 a month, that's $1,100 a month. In terms of taxable, that goes your provisional income. That's about $13,000. So her Social Security won't be taxed. All right. And her annuity and the pension, let's see, she'll have tax. That'll be about 12. Yeah, it won't be taxed either because it'll be under the standard deduction. And at that point, we no longer need to take the qualified dividends or capital gains. So because we're basically backloading her Social Security and allowing that sucker to kick in 4 years or so, and we're able to take distributions on qualified dividends, long-term capital gains, and taking in a pension early and also annuitizing her annuity IRA, we're able to at least make sure that when she hits 65, there will be no tax ramifications at all. And she has guaranteed income to cover her expenses. The guaranteed income, Social Security, her pension from the hospital, and her annuity. And she has guaranteed income to cover her expenses. That means she doesn't have to worry about the 4% rule. The market's going up, market's going down. She doesn't have to worry about politics. She just has to worry about not maximizing her debt. And she doesn't have any debt because she has no mortgage. Part two of this equation, guaranteed income to cover your expenses and no mortgage. You don't have to be rich to have this. And why does she not have a mortgage? Because she was frugal. Her and her husband paid that sucker off. Going into retirement with no mortgage means you don't have to have a huge expenditures to just enjoy a pretty frugal lifestyle and enjoy the life you want to lead. Now, $36,000 may or may not seem like a lot to you, but if you don't have a mortgage, that's not too shabby. Now you can go absolutely, she can go do some traveling. She can absolutely pay the cable bill for sure. Doesn't have to sell the house, doesn't have to eat ramen noodles. She has the income coming in to cover her expenses. And the reason her expenses are so low is because she has no mortgage. And if you've been following this YouTube channel at all, you'll know what I say all the time. If you have no mortgage, or the biggest expense retirees have is by far their housing, by far and away their housing. Nothing even comes remotely close. It's not even debatable. One of the reasons why that is because a lot of people are lately carrying a mortgage into retirement. And in fact, it's interesting. You'll see this inverse correlation. The more people have carrying mortgages into retirement, the less happier they are in retirement. So one's going up and one's going down. So the key thing is here is not to have a mortgage, which will keep your expenditures low, which means you don't need that much income off your investments, which means you can relax. On top of that, too, and if you looked at my other video, the top 10 states that you should not retire in, they're all with high property taxes, because part of the reason for housing costs being so high is the mortgage that you carry and the property tax. So if she lives in a very low property tax state, probably costs her $2,000 a year in property tax, if even that. No mortgage, $2,000 a year property tax, $1,000 a year in homeowners insurance, if even that. So we're talking $3,000 a year is the cost of her housing. That's nothing, my friends, compared to having a mortgage and living in a high property tax state. On top of that, we have enough income to see her through to avoid taking Social Security early. On top of that, once she does take Social Security later, it will grow with the cost of living adjustments as well. And that's when Medicare is going to kick in. And so at that stage, she has no concern for income. Her portfolio does not need to provide it to her. Her portfolio, whatever she gets off, is just money in the bank. And she can spend it by all means, do so. It might change a little bit of the tax consequence, but if the bulk of your retirement income is Social Security, your tax consequences are very, very minimal. And now what happens is she knows every month she has $3,000 coming in guaranteed, 100%. As long as the insurance company doesn't go bankrupt, as long as a pension, PBGC doesn't get involved and have to take over a pension, and as long as Social Security keeps paying what's promised to pay, and which it will until 2034, then it might not. But for her, because it's not that much anyway, it certainly should. Who cares about 50% market decline? It's just not a concern. And the ironic thing is you could hear it in her voice when we talked about this plan. And I didn't come up with it. We jointly came up with it. We had to put our two heads together, come up with this idea. The relief, the satisfaction, the stress level just floating away. It's wonderful. So if you can have those two things for retirement plan, number one, no debt. I'm telling you right now, no debt. Everyone says, but you need a debt. No debt. And the reason you don't want debt isn't because of mathematics behind it. It's because that means you don't have that much income needs to pay the mortgage, pay the car loan, do this, that, the other. You can rely on a whole lot less income to get by if you have no mortgage. And the less income you need, the more Social Security will provide, the more you'll have that guaranteed income covering expenses, which is part two of the calculation. And if you can get those two things combined, you're in a good place, my friends. And on top of that, the taxation will be so much lower because Social Security is bearing a bigger burden of your overall income plan. Social Security is taxed much more favorably. It's a good place to be. Anyway, hope this helps. Like I said, if you like what we see here, hit subscribe there. Don't forget to hit the notification bell to be notified. Try to do an episode a day. Thumbs up are always helpful for sure. Absolutely. In the comments. Love to hear your comments in the comments section. See you next time on the Heritage Wealth Planning. Oh, lastly, if you want to be, I actually do these emails, ongoing emails, about 3 or 4 a week. If you want to be subscribed to the email list, just go to heritagewealthplanning.com. heritagewealthplanning.com, and you'll see my little subscribe to the list there, and we'll get you set up and you'll start receiving the emails. See you next time. Thanks.